Welcome back to Iron Financial. Hit subscribe, hit the bell, and let's forge a stronger portfolio. Today, we are putting a massive multi-industry holding company through an absolute brutal structural integrity test. We are completely tearing down the 2025 and first half 2026 earnings of Loews Corporation, ticker symbol L. I'm your lead analyst, and I am here to cut straight through the corporate fluff. We are going to look directly at the steel beams holding this multi-billion-dollar entity together.
And I'm the market skeptic. Look, you and I both know Loews is a fascinating financial machine. But as an individual investor, I have to ask the really hard questions here. Is this holding company structure actually delivering real, tangible value to shareholders today? Or are we just looking at a bloated architectural marvel that's, frankly, too heavy for its own good?
Well, that is exactly what we are here to dissect in this explainer. We're going to aggressively stress test their segment revenue, their debt structures, their underlying underwriting margins, and their massive capital expenditures, all with brutal analytical precision. No glossing over the numbers. Let's get to work. All right, so here is the core central question that we are welding to the table today. As of early 2026, Loews is sitting on a staggering $4.5 billion cash pile right at the parent company level. For a lot of folks, that right there is the ultimate, unbreakable cash fortress in a highly volatile market.
Right, but for others, and honestly, myself included, it looks suspiciously like a classic value trap. I mean, you really have to ask yourself, why hoard $4.5 billion in cash and short-term investments when your own stock is consistently trading at a massive holding company discount? Are cracks forming in their core insurance and corporate investment engines that they just aren't telling us about? Or is CEO Ben Tish simply playing an overly defensive game of capital allocation?
It's a completely fair critique, and we're going to answer it. To find out if that massive cash pile is a prudent, steel-plated shield or just a glaring missed opportunity to compound intrinsic value, we have to completely tear down the 4 load-bearing pillars of the entire Loews portfolio. So here is our blueprint for today's stress test. Section 1, forging the cash fortress at the parent level. Section 2, CNA, cracks in the foundation. Section 3, Boardwalk, the cash flow anchor. Section 4, the hospitality bet and corporate drag. Section 5, capital allocation and buybacks. And finally, Section 6, the final ironclad verdict. Let's dive into Section 1, forging the cash fortress, the holding company model. Now, you have to understand that Loews is not your standard run-of-the-mill operating business. It is a massive, complex financial structure carrying immense weight across multiple industries: insurance, energy, hospitality, and packaging. At the end of the first quarter of 2026, Loews had $4.5 billion in cash and investments parked right at the parent company level. Now stack that up against just $1.8 billion of holding company debt. That is a fortress balance sheet by absolutely any definition. They are holding highly liquid assets that completely dwarf their corporate liabilities.
Yeah, but here is my issue with that. The parent company effectively acts as the central bank for this entire sprawling operation. The decisions they make at the top dictate whether shareholder value actually compounds or just stagnates. I see the math on that $4.5 billion, but I really don't see the logic. Let's just talk about the mechanics of the holding company discount for a second, because this is crucial. The open market literally values Loews at less than the sum of its individual publicly traded and private parts: CNA, Boardwalk, the hotels. If you firmly believe your stock trades at a meaningful discount to its intrinsic structural value, which, by the way, management claims it does, why let $4.5 billion just sit there doing almost nothing? A cash pile earning basic money market yields is a massive drag on overall return on equity when you could be out there actively retiring your own discounted shares. Now, I know Ben Tish mentioned the pending Boardwalk minority litigation as an outstanding risk that requires a margin of safety. But come on, is this prudent defense or is this just idle, lazy capital?
Well, Tish also explicitly noted that they are entering a period of heavily elevated capital spending over at Boardwalk Pipelines, and he made a point to remind everyone that business cycles eventually turn. He wants that cash buffer to ensure absolute structural durability no matter what the macro environment does. But look, to determine if he's being overly paranoid or strategically brilliant, we need to pop the hood and rigorously inspect the absolute largest engine in the Loews vehicle, CNA Financial. Which brings us to Section 2, CNA, cracks in the foundation. Let's talk underwriting weakness. Let's move right into our microscopic inspection of CNA Financial. Make no mistake, this is the largest, most critical load-bearing pillar of the entire Loews portfolio. And in Q1 of 2026, we saw some very real, very serious structural stress. Let's break down the year-over-year Q1 data, because the math does not lie. net income contribution to Loews literally plummeted 23%, dropping from $252 million in Q1 2025 down to just $194 million in Q1 2026.
Yeah, calling it stress might be an understatement. CNA took a very clear, very painful step back here. I want to look directly at the underwriting margins. If you know anything about the property and casualty insurance business, you know it is entirely about disciplined risk management. And honestly, the Q1 numbers raise some massive red flags for me. Just look at the combined ratio on the screen. It spiked 3.8 full points, going from a profitable 98.4% to a totally unprofitable 102.2%.
Absolutely. And for those who might be newer to the structural mechanics of insurance, a combined ratio over 100% is a huge deal. It means the engine is literally paying out more in actual claims and operating expenses than it is taking in from policy premiums. It essentially means the core underwriting business is running at an outright loss.
Exactly. And it gets even worse when you drill down into the underlying loss ratio. This metric is huge because it strips out the unpredictable noise of major catastrophes and prior year reserve development. It shows you the true ongoing run rate health of the business. And that underlying loss ratio jumped 2.6 points, from 61.5% to 64.1%.
You are totally right to point that out. The underlying loss ratio increase is critical data. CNA management essentially had to admit that in certain casualty classes, their rate increases are simply no longer outpacing the underlying loss cost trends. Basically, inflation caught up to them. They were facing aggregate loss cost trends exceeding their pricing in recent quarters, specifically hitting them in longer tail lines like excess casualty and workers' compensation. And then, on top of that, there is the $106 million reserve development charge they were forced to take in Q1 2026. This is exactly what I always worry about with these massive, complex insurance holdings. They basically admitted their initial estimates for loss cost inflation and claim frequency were simply not conservative enough. Accident years developed adversely against them, forcing them to shore up and strengthen their reserves. The question we have to ask is this just a temporary blip, or are we looking at a sign of a real structural collapse in their core underwriting discipline?
We need to define those longer tail lines clearly for a second. A long tail line simply means that claims can be reported and litigated literally years, sometimes decades, after the policy was actually written. That makes them incredibly susceptible to economic inflation and social inflation like massive jury verdicts. Unfavorable net prior year development added a brutal 4.1 points to the combined ratio this quarter, compared to just 2.5 points in the prior year quarter. But look at it from a structural engineering perspective. Taking the pain early is always better than letting a small crack spread into a catastrophic failure. By resetting those loss picks and strengthening their reserves right now, management is attempting to contain the issue permanently. They are sacrificing near-term growth. Net written premiums slowed to just 1% growth in Q1 to deliberately, aggressively protect the balance sheet.
And here is where the holding company structure really proves its heavy-duty resilience. When we bring the hammer down on the Q2 2026 data, we see an immediate, profound stabilization. In the second quarter, CNA's combined ratio rapidly pulled back down to a highly profitable 96.5%. Even better, the underlying loss ratio held perfectly steady at 64.1%, which essentially proves that the painful Q1 reset accurately captured the new, realistic run rate.
Okay, fine. I'll give you that the combined ratio recovered and got comfortably back under that 100% threshold, but let's not ignore what actually bailed them out here. Net investment income. They leaned heavily on their investment portfolio to cover up those underlying underwriting cracks.
That is exactly right, but you have to realize that is the absolute genius of the insurance float model. Underwriting might have struggled for a minute, but when you are managing tens of billions of dollars in fixed income assets, a simple 10 basis point yield jump to 4.9% acts as a massive financial shock absorber for the whole company. In Q1, their fixed income bucket benefited from a massive $1.1 billion increase in the invested asset base, right alongside that yield increase. And then in Q2, CNA's net income to Loews increased year over year primarily because of this significantly higher net investment income. The asset side of the balance sheet successfully did all the heavy lifting when the liability and underwriting side temporarily cracked. That's structural durability. All right, Section 3, Boardwalk, the cash flow anchor. Let's talk energy infrastructure. Let's move to the next massive load-bearing pillar in the portfolio, Boardwalk Pipelines. If CNA is the complex, highly sensitive financial engine, Boardwalk is the heavy, physical iron infrastructure anchored deep into the ground. The sheer scale of Boardwalk's future revenue visibility is absolutely staggering. At the end of 2025, Boardwalk boasted a contractual revenue backlog of nearly $19.6 billion. That backlog carries a weighted average contract duration of about 9 full years. Now, compare that massive backlog to their 2025 reported net income, which was just $1.7 billion. The future revenue visibility here is absolutely steel-plated.
Sure, the revenue visibility is great, but it's also an incredibly capital-intensive business. Yes, Boardwalk operates in a very favorable long-term macro environment. They are driven by intense natural gas demand, the build-out of massive LNG export facilities, and now even the crazy power demands from AI data centers. But building pipelines requires massive, constant capital expenditure. You simply cannot sit there and praise that $19.6 billion revenue backlog without acknowledging the brutal heavy lifting required on the expense side of the ledger. Boardwalk currently has 9 major projects under development with a projected capital expenditure backlog of approximately $3.3 billion, and that is heavily weighted toward the Kazi Junction project. That specific project alone is a $1.0 billion endeavor that requires laying 110 miles of 36-inch pipe just to expand capacity. So my question is Boardwalk going to slowly bleed the Loews parent company dry to fund all this pipe?
The hard numbers completely say otherwise. Boardwalk is fundamentally a self-sustaining cash flow anchor. In Q1 2026, EBITDA was up 4% to $360 million. And in Q2 2026, their net income increased year over year yet again. This isn't magic. This is being driven by fundamentally higher contracting rates on gas transportation, higher product sales, and significantly increased utilization.
I will definitely concede that their underlying operational fundamentals look very strong right now. They even managed to successfully close the acquisition of Spire Marketing, which is now operating as Continuum, for $215 million in April of 2026. That was a smart move to aggressively enhance their natural gas storage and optimization capabilities.
And here is the absolute most crucial detail for our structural stress test. That $215 million acquisition was entirely self-funded by Boardwalk directly from their own cash on hand. Management explicitly stated that given Boardwalk's highly predictable, massive cash flow profile, they expect the subsidiary will be able to largely self-finance its massive $3.3 billion capital expenditure backlog. I really want you to let that sink in for a second. They fully self-funded a $215 million acquisition while simultaneously managing a multi-billion dollar CapEx pipeline. That makes it a true, undeniable cash machine, and it firmly proves that Boardwalk is not putting an unbearable strain on the parent company's $4.5 billion cash fortress.
Section 4. The Hospitality Bet and Corporate Drag. Hotels and Altium. All right, now we transition to dissecting the explosive hospitality segment, Loews Hotels Co, juxtaposed right against the relentless drag created by the corporate and packaging segments. Look, hotels are notoriously cyclical, and they are a massively capital-heavy business. Loews has been aggressively expanding its physical room count, specifically focusing their bets on immersive destinations that are heavily bolstered by built-in demand generators, like major theme parks. I really want to see if that massive capital layout is actually generating a real, durable return on invested capital.
The return is completely undeniable right now. Just look at this explosive growth on the chart. Loews Hotels reported adjusted EBITDA of $124 million in the first quarter of 2026. That is an absolutely massive 53% surge compared to the $81 million they posted in Q1 of 2025.
Wow, okay, 53% EBITDA growth in a single year is some serious operating leverage. What exactly is driving that kind of jump?
It's the Universal Orlando Resort alignment, plain and simple. Overall occupancy increased by a massive 7 full points year over year, hitting 81% in Q1. They are directly reaping the massive financial rewards from 3 brand new properties situated right adjacent to the upcoming Epic Universe theme park, which frankly weren't fully open and stabilized in the prior year quarter. These theme park adjacencies create an incredibly captive audience, allowing Loews to force extreme pricing power on their average daily rates across the entire Orlando campus. And this momentum wasn't a fluke. It carried right into Q2 2026, where hotel net income increased year over year again, driven entirely by higher rates and more occupied room nights across almost the entire portfolio.
Well, Ben Tish himself said, "We are now seeing the earnings power of our recent investments come through in a meaningful way. I will fully concede the revenue wins here, they are impressive. But as an analyst, we simply cannot ignore the towering debt structure holding those massive hotels up. They have over $2.1 billion in adjusted mortgage debt sitting there."
That is true, but you have to understand it's largely non-recourse project-level debt, meaning in a worst-case scenario where a specific hotel project completely fails, the bank can take the keys to the hotel, but they cannot pierce the corporate veil and go after Loews' main $4.5 billion cash fortress. Structurally, it heavily shields the parent company from disaster.
Fair enough, but the parent company definitely has its own problems to deal with. The corporate segment itself is a constant, irritating drag. In Q1 2026, the corporate segment posted a net loss of $42 million, which is actually worse than the $34 million loss they took the year prior. They are bleeding cash on elevated corporate interest expenses simply from refinancing their maturing bonds at today's higher interest rates. Plus, we already know Altium Packaging continues to face serious rigid plastics demand pressures, which is actively hurting their equity income. The hotel wins are fantastic, no doubt, but the corporate overhead and the packaging weakness are actively eroding those hard-fought gains.
Moving to Section 5, Capital Allocation and Buybacks, which you call the hoarding problem.
All right, this brings us to what I consider the absolute most heated part of our entire structural integrity test, evaluating CEO Ben Tisch's overall capital allocation strategy and his frankly questionable share repurchase discipline. For me, this is exactly where the rubber meets the road. If the multi-industry holding company structure actually works, it should consistently compound intrinsic value per share for the owners. If it doesn't, it's just a massive hoarding problem by management. Let's look closely at the book value evolution here.
I am more than happy to meticulously trace this compounding for you, because the numbers here are completely steel-plated. We have to look at book value per share excluding accumulated other comprehensive income, or AOCI. We deliberately exclude AOCI to strip out the temporary on-paper accounting noise caused by interest rate marks on CNA's massive bond portfolio. We want to see the actual underlying operating value of the businesses. Look at the steady, relentless quarter-over-quarter growth on your screen, from 95.89 at the very end of 2025, climbing strongly to 97.20 by March 2026, and forging straight ahead to 99.27 by June 30, 2026.
Look, I can't argue with nearly $100 a share in intrinsic structural value. That is a solid number. But here is my massive structural critique of this whole operation. If the intrinsic value is nearly $100 a share and the actual stock is trading at a steep holding company discount in the open market, why in the world isn't Ben Tisch aggressively buying back every single share he can get his hands on? In Q1 2026, their buyback action was shockingly, disappointingly muted. They only repurchased 300,000 shares for a total of just $31 million. Let's do the actual math on that right now. They have $4.5 billion in cash, and they chose to spend a measly $31 million on buybacks. That is less than 0.7% of their cash pile. It's essentially couch change for a company this size. Tisch literally said he's more comfortable deploying capital at lower prices and complained that the stock had appreciated meaningfully. That sounds exactly like a CEO trying to day trade and time the market, rather than programmatically retiring heavily discounted equity to benefit long-term shareholders.
You really have to look at the full timeline and appreciate the discipline involved here. Tisch is a highly disciplined capital allocator who is patiently waiting for his perfect pitch. And when the market finally presented a slightly better opportunity, he struck hard. Look at the right side of the screen. In Q2 2026, buyback activity rapidly and aggressively accelerated. They repurchased 1.4 million shares for a total cost of $146 million. That is nearly 5 times the Q1 deployment. He is expertly balancing the absolute necessity of a massive cash buffer for Boardwalk's multi-billion-dollar capex, dealing with the highly unpredictable CNA casualty cycles, and managing the unresolved Boardwalk minority litigation, all while still aggressively retiring shares when that holding company discount finally widens to his liking.
And that brings us to Section 6, the final ironclad verdict, forging a conclusion.
We've zoomed in closely on every single rivet and weld of this massive holding company. Now, let's zoom out to synthesize the structural integrity of all 4 operating pillars into one final ironclad verdict for you, the investor.
We have laid out all the raw data. We have clearly seen the explosive growth in pockets like hospitality and the very real structural cracks in others, like the corporate overhead. It is time to deliver our final, brutal judgments.
All right, I will gladly take the ironclad bull case. Loews Corporation is an absolute financial fortress, period. Boardwalk's $19.6 billion revenue backlog provides literal decades of unshakable cash flow visibility. The massive hotel investments are paying off spectacularly, with 50+% EBITDA growth driven by incredible pricing power. And despite taking a brutal $106 million reserve charge at CNA, that massive insurance engine immediately course-corrected to a highly profitable 96.5% combined ratio in Q2. But most importantly, the book value per share continues to relentlessly compound toward $100. The underlying structural integrity of this business is simply unbreakable.
And I will happily take the value trap bear case. Look, the parent company is hoarding $4.5 billion in cash while only deploying a tiny fractional amount of it to buybacks, despite management's own vocal admission that the stock consistently trades below intrinsic value. Spending less than 1% of your cash on buybacks in a quarter is far too defensive for my blood. CNA's casualty reserve charges prove exactly why insurance underwriting is highly unpredictable, and the corporate segment is just a constant, very expensive drag on overall earnings. The individual assets inside are high quality, yes, but the holding company discount is a permanent structural flaw that this management team seems completely unwilling to aggressively fix.
And that brings us to our final provocative question for you, the investor. Are you willing to wait for the holding company discount to close? Loews Corporation clearly offers exceptional downside protection and steadily compounding intrinsic value, but it undeniably requires extreme patience to actually realize that value in the open market. That wraps up today's Deep Dive Explainer. Here at Iron Financial, our core mission is to help you forge a stronger portfolio through brutal, completely objective analysis. Manage your risk, thoroughly understand the complex corporate structures you are investing in, and always keep compounding your knowledge. Hit subscribe, hit the bell, and we will see you right back here in the next Explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.